Thank you, and it's a great pleasure and a great honor to be here with you all this morning. I was thinking about the global sort of interwovenness both of governments and of economies now, and remembering back around 1990, 1991, when I woke up and was in my office one morning, and they said the news was saying that U.S. markets were down because Asia was down overnight. I thought, wait a minute, the U.S. doesn't go down because Asia goes down. Asia goes down because the U.S. goes down. And that's the way it had been, if you can remember back. I mean, whatever happened in the U.S., the rest of the world would follow. And that doesn't happen anymore. A year ago, I was in Jerusalem speaking at Hebrew University. I was a guest of the government. I was with the president of the Richmond Fed, and we were there to talk about economics. He was the straight man. I was comic relief. But I had some very cool meetings, and we met with the head of the Mossad there. And he was a fascinating, very calm, gentle fellow who seemed even more scary because he was so, calm and soft-spoken. And he said that they really had now significant security concerns in Israel because of the economic crisis in the U.S. That all of a sudden the U.S. would lose economic influence, but that would basically, they felt more threatened in terms of defenses in Europe, in Israel, and that they were going to have to form new allegiances and alliances in order to protect themselves because they couldn't count on the U.S.'s dollars at the same rate that they had been. So all of this stuff, when we hear that something happens even in Dubai, is very much interrelated. We find, I think, a world right now that's awash in debt. 2010, you will have peak government debt around the world, new records around the world, 2010. And there's this assumption now that debt carries some sort of guarantee, right? That it's going to be backstopped, that some central bank will step in and make sure that you don't get into too much trouble. It's almost like carrying catastrophic insurance. The Federal Reserve has stepped in here and intervened, and they kept us from real disaster. It was very, very close to collapse a year ago in the financial system here in the U.S. But that guarantee then goes beyond moral hazard, in my opinion. That guarantee that says you really can't fail significantly, ultimately, makes me feel better as an investor. Does it make you feel better as an investor? Because that's a really important question to an investor or to an economist, how you feel. And if you feel more confident because you know things aren't going to be allowed to collapse. I mean, okay, I've got risk to a certain extent, but I know the Federal Reserve will come in at some point. Changes my appetite for risk, right? You remove consequence, and I'm all of a sudden become pretty wild and crazy. If jail and the Washington Post headlines aren't really a threat out there, my behavior may change. My wife's not here. But things are changing, and it's going to be interesting to see how things react to some of these consequences. The European Central Bank has been watching their deficits very closely. Some of those Eurozone deficits represent, I think, probably a significant threat right now. In Greece, the deficit this year is around 12.7% government deficit. Now, by 2013, the EU has said throughout the Eurozone, deficits have to be at 3% or below. The Greek government has said, well, we're going to shoot for 9.7% next year. And the EU came back and said, the EC came back, European Commission came back, and said, you're pretty much on your last 12 months of liquidity supplied by us. And Greek bonds dropped significantly. So without that government support, the debt becomes more questionable and the interest rates rise. Now remember, 2010 is going to be peak world debt. Without the government support, what happens to those interest rates? What happens to the cost of that debt? And the cost of that debt on a government's balance sheet and the debt service all of a sudden has a multiplier effect. So what's happening around the world, I think, is very significant here. You know, it's mind-numbing to me that the U.S. market reaction to $3 trillion, $4 trillion, how much money of stimulus and intervention have we seen? It's pretty significant. It's over $2 trillion on the Fed's balance sheet alone right now. So you come up with the right number. But with all of that stimulus in the last 12 months, and a lot of it hasn't reached the market, but the promise of it certainly has reached the markets. And we know that those anticipatory things have real effects on behavior. That the market's reaction has been that we're ready to celebrate the resiliency of the U.S. Economy and markets. Wait a minute, you just shoved $3 trillion into this system, and now you're saying we have resilience. I mean, it isn't bad, but it doesn't look like resilience to me. It looks like the life support worked, the shot of epinephrine, adrenaline worked, and the patient's still moving. So my concern here and around the world really has to do with the deficits and the debt, because all deficits get funded sooner or later. One way or the other, deficits get funded. And with the balance sheet changing, with the debt increasing and debt service increasing, that gets to be a much bigger hurdle if you're going to try and do it organically and not start printing money and not just monetize it. And I'm trying to find a way where where that won't have to happen, and I'm coming up a little short. You know, I think finally that stimulus and government intervention that save a financial system from the brink is certainly to be lauded. But I think when it interferes, when it goes an extra step to say that we're going to cushion you against consequence, that we're going to take out the risk, and at the same time interfere with the normal cycle of expansion and contraction that have always been a part of any normal economic cycle and life, I think that you begin to tread a very perilous path. So we are recovering, I think, and I think we're seeing some very positive signs. I just don't, if you can hear it, I'm not thinking it's going to be a V-shaped bounce here.